Happy Thursday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. And today we need to begin in Europe. The recent moves on the geopolitical chessboard suggest a shift in global trade dynamics, with Europe, China, and the United States at the center. US President Donald Trump's decision this week to temporarily back off from his threat to impose 50% tariffs on the European Union comes amid ongoing behind-the-scenes negotiations aimed at reshaping the landscape of trade with China. Although no formal agreement has yet emerged, reports indicate that the EU has, quote, privately indicated, end quote, its willingness to collaborate with Washington to address long-standing concerns about China's state subsidies for key industries, a development that could profoundly impact Beijing's economic strategies. Behind this tentative detente lies a strategic US path to rally its allies in applying pressure on China's non-market practices. The US-based Wall Street Journal revealed that while the EU has not committed to new tariffs on Chinese industries, discussions have intensified, and a recently exchanged set of negotiation documents has raised hopes of a broader, coordinated approach. The UK, as part of its own separate trade negotiations with Washington, as we have seen, has already moved closer to imposing tariffs on Chinese steel, a step that helped secure the US-UK trade agreement announced earlier this month, and a move that Beijing strongly condemned at the time. Now, Chinese officials are not standing idly by. Commerce Minister Wang Wentao is expected to meet EU Trade Commissioner Maros Sefcovic in Paris in early June during a World Trade Organization gathering. Sources familiar with the planned talks suggest that the discussions will focus on preparing for a broader China-EU high-level economic dialogue, potentially scheduled for July. However, optimism remains tempered by the reality of slow progress. EU Ambassador Jorge Toledo warned that technical negotiations on issues like tariffs on Chinese electric vehicles, EVs, and China's investment in EV supply chains were stagnating. Quote, "We are not making progress, so much so that we were supposed to hold the high-level economic and trade dialogue," end quote, he said, adding, quote, "and I'm afraid we are not going to hold it because we need deliverables," end quote. Further complicating the outlook are reports suggesting that China has continued supplying critical technologies and components to Russian defense manufacturers, a revelation being said by Ukrainian intelligence. This has fueled geopolitical tensions that could make it politically challenging for the EU to pursue a conciliatory path with Beijing, especially as G7 leaders, though avoiding explicitly naming China, have warned against the, quote, excessive imbalances, end quote, created by non-market policies that threaten the integrity of the global trade market. All agree this was aimed at China. We discussed this at the time as well. Despite these diplomatic overtures, the EU's willingness to work with Washington on addressing China's economic practices signals a growing alignment of Western economic interests. However, whether this will result in a joint US-EU front imposing coordinated tariffs on Chinese industries, or whether it will push China toward further economic decoupling, remains unknown. Meanwhile, even as the EU policymakers weigh their strategic options, European businesses operating in China are voicing a deepening sense of frustration and pessimism. This week, the European Union Chamber of Commerce in China, in collaboration with Roland Berger, released its 2025 Business Confidence Survey, painting a stark picture of the challenges foreign firms face in the world's second-largest economy. The survey's findings are striking. A record 73% of European firms reported that doing business in China became more difficult in 2024, while only 29% expressed optimism about their growth prospects over the next 2 years, the lowest level on record. Even more tellingly, just 12% of respondents were confident about profitability during this period, underscoring the harsh realities of operating under rising regulatory hurdles and intensifying geopolitical tensions. Interestingly, the key reason behind the malaise is not concerns around US-China trade tensions, but rather China's economic slowdown, which was cited by a majority of respondents. The president of the EU Chamber of Commerce in China emphasized this point, quote, "Now, by a wide margin, it is China's economic slowdown that is seen as having the greatest impact on future business," end quote. The survey also revealed that 63% of firms missed business opportunities in 2024 due to market access and regulatory barriers, and 52% felt that the business environment had become more politicized. Nevertheless, there were nuances. Despite their downbeat outlook, many European firms continue to source components from China, drawn by the country's competitive pricing and resilient supply chains. As the report says, quote, "It's a little bit counterintuitive. Companies are super pessimistic, they're not earning money, the environment is politicized, there are market barriers. But for economic reasons, you simply need a presence in China to source components and stay competitive. End quote. Notably, fewer than 40% of European firms plan to expand operations in China this year, the lowest proportion on record. By contrast, 36% reported having no plans for expansion, the highest ever recorded, even surpassing the figures from China's stringent zero-COVID lockdown era. The sentiment has clearly shifted from cautious optimism to one of strategic retrenchment and risk mitigation. As the EU weighs cooperation with the US in applying trade pressure on China, European businesses are simultaneously grappling with an increasingly difficult operating environment within the country. The next few months may reveal whether these two tracks, geopolitical maneuvering and private sector caution, will converge into a broader rethinking of Europe's economic relationship with China, or whether they will diverge. Policymakers pressing ahead, even as businesses reconsider their long-term engagement. A lot is happening in the coming weeks and months as the world goes through a massive trade reset and on the geopolitical level enters a much more uncertain era. If you want to be on top of the most up-to-date developments as they happen, make sure you're subscribed to Market Update, hit the bell notification icon and you will be. Interestingly, 50% of regular viewers of Market Update are not subscribed. If you are one of these regular viewers and you'd like to support this channel and see it grow and continue, it's a tremendous help if you just hit the like button and that subscribe button. It's 2 clicks of the mouse, but it's a big help for me, and I deeply appreciate it. Now, let's move to US markets. The outlook for the long-dated US Treasury market continued to darken, with yields hovering dangerously close to the key 5% threshold. On Wednesday, the US 30-year yield settled at 4.97%, following a spike to 5.15% last week, the highest level since October 2023. This persistent strain underscores mounting concerns over the $29 trillion Treasury market stability. A JP Morgan survey published yesterday has intensified worries. The survey's all-client category for outright short positions, which includes central banks, sovereign wealth funds, real money investors, and speculators, has surged to its highest level since mid-February. Key drivers of this sentiment include the US losing its last top-tier credit rating, the House's passage of the spending bill that adds trillions to the nearly $37 trillion national debt, and sharp declines in Japan's super long bond market. These are all developments we followed at the time. Quote, "This is a global steepening of yield curve," end quote, said the portfolio manager at Lord Albert & Co., adding, quote, "Demand for longer-term securities is diminishing at the same time as supply is growing, putting pressure on the long end of yield curves worldwide." End quote. Amid this backdrop, US stock index futures rose sharply on yesterday evening US time, suggesting a strong market run today. Thursday, a federal trade court ruled that US President Donald Trump lacked authority to impose sweeping tariffs, voiding levies that had sparked a global trade war. The White House plans to appeal, but investors interpreted the decision as reducing the risk of broad tariff hikes. Futures on the S&P 500, Dow Jones Industrial Average, and Nasdaq 100 climbed 1.4%, 1.1%, and 1.7% respectively. Nvidia's earnings report after the close added to the market's optimism. The chipmaker's shares jumped 5% as its first quarter revenue surged 69% year-on-year, beating expectations. Nvidia's performance is seen as a bellwether for the technology sector's trajectory, with traders bracing for significant stock movements. On the trade front too, in North America, Canadian Prime Minister Mark Carney revealed intensive talks with the US on a new economic and security deal, hinting at potential progress before the fall. And finally for today, the Bank of Korea delivered a widely anticipated interest rate cut on Thursday, today, local time, aiming to bolster South Korea's export-driven economy as it faces the twin challenges of US trade tariffs and domestic political upheaval. The central bank reduced its 7-day repurchase rate by 25 basis points to 2.5%, marking the fourth cut since it began easing in October. The Bank of Korea also slashed its growth forecast for 2025 to 0.8%, down from the earlier projection of 1.5%. quote, the domestic economy is expected to see a marked slowdown in growth this year, even as inflation remains on a steady trajectory, end quote, the Bank of Korea said, adding that uncertainty over future growth remains elevated. The rate decision coincided with a continued decline in the South Korean won, its currency, down 0.6% against the dollar, and a slight dip in government bond yields. Analysts from Q1 Securities, in a note published today, expect further cuts to bring the base rate to 2.25% this year. The Bank of Korea's move comes as South Korea's economy struggles with faltering exports, subdued investment, and weak consumer spending. The recent appreciation of the won has provided additional room for easing without stoking inflation, while the US trade measures have further complicated the outlook. Though some of President Trump's tariffs were scaled back, Korean exports for autos, steel, and aluminium remain heavily impacted. Adding to the complexity is the upcoming presidential election on the 3rd of June, just weeks after the impeachment of former President Yoon Suk-yeol. Frontrunner Lee promises massive fiscal stimulus, while his rival Kim Moon-so suggests a similarly sized public welfare package. Analysts suggest this fiscal push could ease the burden on the central bank, though trade tensions are expected to remain a drag on growth. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Thursday, and I will see you for another episode tomorrow.